Hello and welcome to Hot Money on BloombergQuint Live, India's first digital live streaming business news service. This is a show which gives you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our guest on the show. Joining us today, Avinash Gorakshakar of Profitmart Securities and Mridul Jalal of Senora Advisors. Many thanks to both of my guests for joining me today. On the show today, we'll analyze the numbers of Asian Paints. It was a steady quarter with the decorative business seeing a lower double-digit volume growth, but the counter is rather soft in today's trade. We discussed L&T's number which met estimates and met the estimates and maintained the guidance for FY20, both on the order front as well as revenue front. The counter is doing well in today's trade. Most of the private banks have now reported the numbers. We analyze the numbers and ask whether there is any case of accumulating these banks or whether it's an avoid at this point of time. And lastly, we discuss Zee Entertainment, which and whether the worst is over for the company. So that's something that we will discuss in today's edition of Hot Money. But let's start with the first one, and that is Asian Paints. Now, Asian Paints came out with numbers yesterday. Even though the numbers were in line with estimates, the volume growth was strong. Lower double-digit volume growth is that came in. But nevertheless, post the numbers, the stock is trading a little bit of headwinds today, so it's down in today's trade. What's the view ahead, and what do you make of the numbers? Avinash, what's your sense? What did you make of the numbers?
No, I think, numbers were definitely in line with expectations, but I think obviously lower commodity prices helped the company to maintain and slightly improve the EBITDA margins. But I think volume growth definitely was a tad below expectations. And I think the auto business, as a company also mentioned, due to the ongoing kind of crisis in the automotive sector, we don't expect that even the fourth quarter is going to show any dramatic improvement. Our sense is that, lower commodity prices are just one element, but the volume growth kicker is something the markets are looking forward to, and that may not happen at least for the next 3 to 4 months. So I think at these levels, Darshan, my sense is we are telling investors to actually hold on, no fresh buying here. Only a correction could offer a good risk reward, and I think as everyone is aware, they have a large market share. So I think this is a more or less a duopoly or a three-player market. So I think wait for a correction to actually dip in here, but at the current levels one can hold on.
Would that also apply to the other paint companies? If someone wants to play the paint theme, is Asian Paints the best bet, or should they go in for someone else at a cheaper valuation?
I think I would prefer, if one were to look at a choice, I think Asian Paints would still continue to be my number one bet, and second would be Berger Paints. I think Berger Paints has definitely displayed good volume growth and EBITDA margins over the last 2 to 3 quarters, and clearly I think in terms of their reach and in terms of their product mix, I think they could definitely do better in the coming quarter. So I think clearly, even as far as Berger is concerned, I would be clear that it's better to buy on declines, not at the current levels, although I do believe that softer crude prices could actually percolate down into better margins, but the volume growth kicker would possibly take at least 1 or 2 quarters.
Okay, that's the view that's coming in on Asian Paints. I think the consensus view is that wait to accumulate Asian Paints at a lower level. No doubt valuations are extremely aggressive, and there could be more cool off on the stock, and that's the time, if you want to take a position, that's the time you should start to accumulate. The second stock we want to talk about is Larsen and Toubro, trading pretty much with positive bias today post the numbers. The numbers, however, were slightly weak, but I think the management commentary on the guidance and them being confident on meeting the order inflow guidance of 10 to 12% and the revenue guidance of 12 to 15% somehow being liked by the street. Avinash, firstly, what did you make of the numbers?
No, I think definitely a good performance in a difficult quarter, and I think the markets like the order inflow in this quarter, about 41,000 crores, and this was a decent 11% growth. And I think the markets were also quite positive on the fact that the management has continued to maintain its guidance of 10 to 12% for quarter 4. So I think markets are definitely looking forward that despite challenges in the macro environment, company clearly mentioning that payments are not coming in time, the working capital ratio having improved from almost 19% to almost 23% for quarter 3. Our sense is that heavy engineering and the infra segment are going to be laggards even on the fourth quarter, and obviously if the company does maintain 10 to 12% growth, that would be a decent kind of growth. But fourth quarter definitely, Darshan, is going to be a very, very difficult, challenging period, considering that working capital constraints continue to hurt the company. So as of now, we have got a market performer rating on the stock. We would not be aggressively buying into it, and probably wait for the management commentary post the Q4 numbers.
Okay, what's your sense on the fourth quarter? You said it will be challenging. You think they will be able to meet the guidance? The management is confident, are you?
No, I think my sense is, I think fourth quarter guidance is going to be challenging. Hopefully, they have a pipeline of orders. I think the order execution, Darshan, is also going to be very important. And clearly, if liquidity concerns persist, which clearly came out from the management commentary that working capital funding has gone up, government is not giving them funding, on time. So I think these are issues which are going to bog the liquidity and the stock. But yes, market is definitely happy about it. I would believe that yes, to a large extent, the market is confident. Even we would believe that this guidance could come in, but then thereafter what happens for FY21 is something which is going to be crucial, because post the budget there are a lot of expectations that infrastructure would get a significant boost and hopefully drive growth for the current year also.
Okay, that's the view that's coming in on L&T. The next stock we want to talk about sorry, is basically the private banking sector. Now, you name the bank, be it a Kotak or be it an IndusInd or being an HDFC bank or be it an Axis. Most of them actually on the financial side and the asset quality side did manage to disappoint, but most of them have managed to rebound in today's trade. Axis has come off significantly from the day's high. But what's the sense on these banks going ahead? What's the best pick? What is the stock that you should avoid? What did you make of the earnings season for private sector banks?
No, I think clearly across all the private sector banks, I think one thing is was very much clear, that asset quality and slippages have increased significantly, and I think this was very much evident in IndusInd Bank and typically even Kotak Bank, where the management has clearly hinted that some further pain points could come in. I think on the retail side, HDFC Bank or typically ICICI Bank, I would also tend to agree that these are banks which have got a more stable kind of portfolio, and probably quarter 3 could be much better, and even going forward FY21 could be a lot better because most of the asset quality stress is out. HDFC Bank also reported a slight increase in their asset quality, though marginally, and of course NII growth was very slow in amongst the lowest amongst the last 7 quarters. But overall, if one were to look at portfolio distribution, I think both ICICI Bank and HDFC Bank, I think Darshan, at declines could definitely be accumulated. I think IndusInd Bank could be a little more volatile, and as far as Kotak and RBL Bank are concerned, I would prefer to wait. I think probably Q4 also could be a little more challenging, and there could be some further price correction.
Okay, that's the view that's coming in on the private sector bank. And the final last stock we want to talk about is Zee Entertainment. Did manage to rally yesterday. Today it's down almost 4%. The last time I checked, pull up the stock and we'll see what exactly is happening. It's down almost 6% in trade. Numbers not the best of numbers, but I think some bit of positive cues were coming in the con call, which actually has gotten sold into. Avinash, what's your sense on Zee now? Now, most of the concerns are known in the open. It's one of the largest media companies, and now you're getting it at this valuation. Should someone, let's say for a longer term perspective, put money into Zee, or you think it's a big risk putting money here?
No, I think looking at the operational numbers, numbers were definitely disappointing. If you see the ad revenue, the subscription revenue, and the kind of margins which they have registered in this quarter, I think very disappointing. And I think the markets are concerned that compared to the previous quarter, that is quarter 2, quarter 3 also, there have been some contentious issues on the recoveries, on some 1 or 2 accounts. Now, when this money would come back is a key question mark, and I think that is probably the main reason there has been a big overhang on the stock. As far as the pledging factor is concerned, Darshan, now the pledging factor is out, so that is not going to have any reaction on the stock price. But overall, if you look at the operating metrics, I think probably 1 or 2 quarters the going is going to be a little challenge. The new TRA issues are also going to play an overhang on the stock. So I would believe it's going to be a market performer, and anybody who adds a very long-term view over the next 12 to 18 months could definitely chip in. Those investors who got a very high risk appetite, because this is a unique business and not many players could obviously manage to mirror it. So clearly, from a short-term point of view, I would avoid it, but from a longer term point of view, this price looks attractive, considering that most of the negatives are in the price, and I don't think you're going to see any panic selling now from here on.
Okay, and what's your sense, Mridul? Zee?
In our profile, it's a avoid. It's a clear avoid. While I understand that it has corrected even from valuations in absolute terms from the top, but what you have to realize is over the last 5 years, Zee got re-rated at every interval period of time. Hence, to look at a mean perspective is going to be wrong, because this is the first time after a long gap that you are seeing a FCF negative. And I really don't know if FCF will be positive for FY21 or not. Because if the ad growth revenue doesn't come back, then it's tough for the company. With the investments on G5 and content and everything, while pledge overhang gone has helped the company to be re-rated from 240 odd levels to 300. What we need to understand is 300 is where the deal happened. So if the company doesn't give growth, a lot of people who bought at those levels for medium to long term will continue, they start selling. So my sense is 300 to 320 is fairly valued or slightly higher than that, and that is a zone where investors may look for some exit. So both from a fundamental and valuation perspective, Zee is a avoid for me, both in short term and medium term, until as we see some green shoots coming both on FCF and ad revenue growth. That's a parameter we are closely tracking there.
Okay, so that's the view that's coming in on the final stock, that is Zee Entertainment. But with that, it's a wrap on today's edition of Hot Money. Let me thank my guests, Avinash and Mridul. Thank you so much for coming in today. Ask BQ comes up next. Stay tuned to BloombergQuint.